Today, from a macroeconomic viewpoint. Hello again, it's Martin North from Digital Finance Analytics. Welcome to our latest post covering finance and property news with a distinctively Australian and indeed New Zealand perspective. And today I'm joined by Chris. Hello, Chris.
G'day, Martin. Good to speak.
Thank you very much for spending the time with us. So we should just start with a few introductions. So can you introduce yourself and essentially just set up the viewers in terms of understanding where you're coming from?
Sure, absolutely. So, unlike yourself, I'm not a specialist in the Australian or New Zealand markets. I run a firm and managed capital, which is macro-oriented. So I look essentially top-down. I spend a lot of time focused on all the macro factors, capital flows, things of that nature, and then essentially drill down into sectors that I believe are going to either inflate or deflate, essentially, as a consequence of some of these macro factors. So that's kind of the basic viewpoint. I guess that's what my firm does. But the topic, I guess, for today is good old Australian housing, and it's one that, you know, you and I could have. There's many things, I guess, for any investment-orientated blokes like ourselves, which we could look at and say are unsustainable, they're unreasonable, and they're downright batshit crazy. And certainly Australian housing sits in that bracket. What's interesting to me is that, and I've kind of learned this from the School of Hard Knocks, is that you and I could have sat down 2, 5, even 10 years ago and looked at some of the dynamics and gone, that doesn't make sense. That shouldn't be the case. And we're still sitting down today with the same topic. So I think that what's required for any market to change, and markets change at the margin, it's never some major event. It's normally just a marginal change, especially in any market which is inherently driven by credit or leverage, as most people would understand it. And that's kind of where I'm interested in the Aussie housing market. It's been one that we've at the firm watched for literally years and been extremely tempted to bet against, and we've held off, and we've got a whole portfolio of different types of setups like that, and we have to often caution ourselves to not necessarily, to maybe take a very small 1% position or something of that nature just to keep your eye on it, but to be cognizant that you need to have that sort of sea change, and you might miss the first 10%, and that's who cares sort of thing. So I feel like we are at that. We've had that first 10% move, and there's a whole lot of reasons that we can discuss as to kind of why we've started pressing the pedal, so to speak, in that particular trade.
Okay, so it's interesting, of course. There's a guy called Steve Keen who you may or may not know, but Steve was down here more than a decade ago and essentially called a housing crash, and in fact bet against a couple of other people and ended up having to walk down to Kosciuszko National Park because he lost his bet. And he subsequently said what he missed was the ability of the banks to continue to lend and the government to continue to effectively allow credit to grow. And I think that's a really good example of, if you actually get the call wrong from a timing perspective, it may be right, but actually you can also be very wrong for a very, very long time. And, I speak with quite a few international investors and hedge funds who are looking at the Australian market, and up till very recently have been saying, well, we don't think that all the signs are there yet that things are really going to go pear-shaped. However, I have to tell you that in the last couple of months, particularly the last 2 months, those voices have changed, and they're saying a bit like you. There seems to be something going on which suggests that we are now at a bit of an inflection point. And whilst they were sort of sitting on the sidelines previously, some of them are now saying, well, maybe it's time to get a bit more actively involved. So I'm interested that you think that, you know, things are on the move. Can we just go through then for what you think some of those leading indicators are, and why it is that you think that now we've moved beyond, if you like, that first phase?
Yeah, look, Martin, I guess we could run through a lot of the, I'd call them fundamentals. And these are topics, some of which are more prevalent today than they might have been a few years ago. We've got things such as just economic indicators. The construction index has been falling for what, 7 months, I think, now in a row. You've got the Royal Commission, and that kind of ties into what will be almost certainly tighter lending standards. There's the potential probability, I'd say, that Labor get in the next election, and they're promising all sorts of things, but essentially there's two main components there. One is immigration, and I'll come to that in a minute because that was one of the main factors that we've looked at, and then the other is things like capital gains tax and taking away some of the incentives, if you will, that have helped to drive a lot of the capital inflows into real estate. And so those are, I think they're important, and there's never necessarily any one tipping point. There's often a host of different factors. For me, and just on that point, then you've got a lot of the indicators. You know, auction clearance rates are, I don't want to use the word collapsing because people sort of think, oh, you're trying to be sound a bit bombastic and things like that, but essentially they are they are falling, certainly. But the main thing that is interesting to me is around the euro-dollar market, and this is a point that most people tend not to spend a lot of time on, but you've got roughly 40% of most, we'll look at the main Aussie banks. There's the other sort of tertiary, other lenders, and a lot of them actually fund in the wholesale market as well. So that they're more susceptible than the bigger banks. But even within the big banks, firstly, their loan books are extremely heavily sitting in mortgage, in residential and commercial real estate, much more than other markets. You know, I had a client of ours saying, oh, because I wrote an article about crazy real estate markets, and I listed out a bunch of them. And within that, we talked about Hong Kong, and you're saying, well, why shouldn't we be short Hong Kong? And there's, firstly, you could have a view on a particular market, but it's important to know how to execute on that view. You could have a view and you could be right, but if your upside is making 5-10%, then do you really want to, you got to determine how to execute and whether that's actually going to pay you. And when I think about places like Hong Kong, they got roughly about 15% of their book. So yeah, that'd get hurt if you had a crash in the real estate market there, but then you've also got capital inflows from China. There's other dynamics there. But so fine, you could have a crash in real estate there, but how would you play it? How would you actually profit from it? And the automatic response of, oh, we'd be short the banks, I might be missing something, but that doesn't seem like a relatively good bet for me. When I look at Australia is way, way different. I mean, they've literally got all their eggs in one basket. And so the banks are really interesting to me, but within that banking structure, there's roughly 40% of that stuff is wholesale funding, it's wholesale finance, it's in the swap market. And so to think about those rates are going higher, and I wanted to sort of work through why they fund in that market firstly, and how crazy that market became, and this, because this is Australia is really just a symptom of a much wider problem. It's one that's managed to become, I guess, more asymmetric than many other markets, and that's basically as a consequence of the commodity boom that they had, which when that ended, there was a massive, and it was similar. So like you had the '08 crisis. In the '08 crisis, we had what was completely unprecedented. We had global political coordination, which worked in with financial coordination at a level we've never ever seen before. The only time we've had that sort of coordination was actually World War II, right? So you had the ECB, the Bank of England, the Fed, the BOJ, all the major central banks in the world, including the RBA, all basically came together in a kumbaya. We're all going to fix this problem. They all saw that there was risk to all of them. And as a consequence, they kind of all came together with a similar strategy. And essentially all they did was they took private balance sheet risk and moved it onto the public balance sheets. And they opened swap lines. They provided massive dollar liquidity. And rates collapsed. So that allowed for a stimulus across the world, and you can see it in the real estate market in Aussie. You know, you had that dive, but then it came out of it and came out of it really quickly, partly as a consequence of that massive coordination by central banks to provide liquidity to the system. But also Australia literally opened the doors to immigration on a massive scale. You can look at the numbers for Chinese immigration. It went through the roof. And so you had this massive influx of both people and capital, which really helped to mitigate any of the other forces that were impacting that market and many other markets at the time. And so that's really important to understand, because I'd suggest we've already moved in many countries, and Australia is now moving down that path towards much more nationalism. And I wrote an article back in 2016 talking about this rise of nationalism across mostly the Western world, and it pertained to Brexit and Trump. And what we're seeing, for example, in Europe now with Salvini, and what the media are calling right wing. Many of them are actually kind of more centrist, but it doesn't really matter. The point is it's more nationalist, and it's than it has been. And Australia's moving down that path as well, or appears to be. And so that whole immigration, look, that's already been cut off largely. They've already reduced the amount of Chinese buyers and all that. So that part of capital flow has already come under pressure. But the main thing that got us really excited, if you will, was looking at that dollar funding, that wholesale dollar funding. So you've got, let's just, for argument's sake, you've got 60% of the book is sitting in domestic capital. It's financed domestically. And the balance is financed offshore. And there's two components there. One is the rate of the cost of capital, and the other one is your FX swap, because you're borrowing in dollars, US dollars, and then your income stream is in Aussie. So those are the two major components.
And let me just ask. So if I take that, I agree. And there's also long-term and short-term, isn't there? So we know that some of that foreign debt is effectively on 90-day rolling, and the other is between 2, 5, 8 years. So there's a term dimension to this too, which I think is really important, and some people don't get that.
No. So and look, if you and I were running any of the bank, our own little bank, the Martin Chris Bank, and might not be the best name, but so we would structure our book. Let's say we've still got 40% of the stuff in offshore wholesale funding. We're going to have some of it on floating. We're going to have some at 3 months, some at 6, some at 12, some at 18, some at 24. and we're going to structure that. We're not going to have all in one, right? We're going to have it all structured out. And so as those maturities roll over, we go back into the funding market and we keep going. So at any one point in time, we're not being hit with a massive tranche at a 12-month or at a 6-month or whatever. So we can basically manage our cash flows and watch that market moving and be able to adjust our domestic capital, maybe sort of try and pull some more in from that and reduce our offshore or vice versa. So all the banks do this in their treasury departments all the time. But what we've seen, and I spent some time on a phone the other day with a good friend of mine who used to run the treasury book at Westpac. Now, this is some years ago, but just to really fully understand how that all works, and he still speaks with many of his friends at the banks there to keep abreast of what's going on. It seems to be that as that wholesale funding rate increased, and all we need to do in order to determine what that looks like is look at LIBOR. So LIBOR since late 2015 has done nothing but scream higher. And that's been irrespective of central bank rates, right? So the Fed has been the first to move, but they moved way. So the euro-dollar market started pricing risk differently before any of the central banks started moving. That's now just icing on the cake, and it's causing all sorts of dynamics in global financing markets. That's causing a dollar shortage, essentially, because the Fed's they're tightening, they're raising rates and they're tightening because all of that is just sucking dollars out of the system. But before that, the risk was being repriced by I'm gonna call it the real market, the non-central bank affected market. Just people. I mean, like the euro-dollar market is literally most international. We don't know how big it is, but we know it's about 90% of international trade is financed in the euro-dollar market. And maybe it's a little bit less, maybe it's a little bit more. It doesn't really matter. It's massive. That entire market's larger than the 10-year bond market. It's larger than the S&P futures. It's a huge market. It's completely unregulated.
Yeah, I was going to say, let's just pause there because some of the viewers may not understand. So the thing about that market is it's outside, if you like, the standard central banks sort of coordination and control, right? Because basically it's money in the international markets.
It's kind of free market money.
Exactly. Yeah.
It's like you and I and large corporations, and I might look at your balance. Look, I used to work in investment banking in Europe and London, and basically at the end of the day, what happens is if you're sitting at Deutsche and you go for drinks with the boys at JPM or vice versa, whatever, after a few beers they all talk. These guys tend to know what the balance sheets of their competitors look like, and that ends up getting priced when they sit down on a Monday morning and they start doing their trades, and they're like, oh, Joey told me that they're screwed on whatever it is, the holding and so on and so forth. So that pricing of risk is independent of central bank. It's somewhat independent of central bank pricing of risk, and so it's a really, really great indicator to understand what the I'll call it the free market thinks about risk, and that risk has been shooting higher. I mean, we're sitting now. So late 2015 was just under 50 basis points. Today we're nearly 3.5. That's a significant move, especially when you have a massively over-leveraged market or any leveraged market. And so that's interesting because it comes back to the 40% that Aussie banks are sitting with that is being funded in that market. Now, you realize that at some point those maturities start rolling over, right? So your 6 months has already rolled way back, and they keep rolling it in the 12 months and the 24, and what's interesting, because we were sitting waiting to see banks start raising rates, not because the RBA can do whatever the hell they please. It's not forget about that component of it, right?
Mm.
It's this offshore component which the RBA have got no control over. And I'm sitting watching these rates moving, and then I'm looking at the banks and they're not moving rates. I'm like, what the hell is going on? I know how this functions. This
Yep.
doesn't make sense. And from what I can tell, speaking to people in the industry, it's like if you think something is short term, you'll take, like if it was the Martin Chris Bank, would take the hit. We go, look, we don't want to lose market share. Okay, we want to keep our customer base. We don't want to piss anybody off. We don't want to. So we'll let that. We'll ride that trough if we need to. We might take some of it as a hit to our income statement. We might whatever. Maybe we're sitting with some loans that we don't really like. Well, screw it. We'll securitize them and move them off the balance sheet. But nothing was actually. You couldn't see anything happening with respect to them raising rates, and that's now changed. So Westpac have raised. Now they're all raising. And that, I believe, is why, because it's got nothing to do with what the RBA do. It's the fact that their wholesale funding costs are going up. And importantly, they've now kind of gone, oh, it's maybe not short term. Because if it's short term, you just take the hit and you keep your market share, you keep going and you wait for it to come back down. There's now the sea change where they're going, this is probably a longer term thing. This is not just short term. We're going to have to make a move here. And so they're making that move.
And it's worth saying, Chris, that my calculations suggest that whilst they have moved some of those rates up, they are actually still sitting on margin compression relative to last year, right? So in other words, they haven't taken the whole pill yet, right? They've taken about maybe a quarter of it. And the longer they leave it... Not
only that, those rates are still moving higher.
I was going to say, the longer they leave it, the bigger the problem, and the more rates are moving against them. So effectively, they're actually seeing this whole pincer movement.
It's funny, because you get... If you think about that, Soros talks about this in The Alchemy of Finance, and he talks about reflexivity. And what we've had, if you think about where we've come from, we've had this extremely... benign political environment. Okay. Again, kumbaya, we're all come together, that '08 crisis, and everybody was in it together. And there was this extreme coordination. And if you look at the world today, it's politically fracturing at an accelerating pace. And so the idea that on a political level, we'll all come together in I'll call it the West, I think it's bullshit. It's not going to happen. And we're already seeing trade wars and on all these sorts of other ramifications flowing through. Also, new governments are getting elected, and they're much more nationalistic than in the past. Globalization, which is one of the things that's driven world economies for the last 10, 20, 30 years, is potentially going to go through a period of reversing to a certain extent. And a lot of that is... So globalization was quite deflationary because you essentially just added these huge labor pools, low-cost labor pools, and the West kind of benefited in terms of lower tech goods. That's why you can go and buy cheap LCD TVs and Apple iPhones and all this kind of nonsense. And so as that reverses, it changes all sorts of different markets. But when you think about that, so like the RBA can sit there and they can keep rates low, but what's happening outside of Australia is significant enough to really affect those markets. And the other thing that's interesting is because now you have a massive rate differential, right? So, for example, this is the first time that the Fed funds rate is actually above the equivalent of Australia's. It's the first time in, I think, 18, 19 years, something like that. That's pretty, it's extremely rare. And what you're finding is that capital starts shifting towards the higher yield and quote unquote lower risk, which is essentially US. Why wouldn't you own a US bond as opposed to an Aussie bond? It just, doesn't make a whole lot of sense. And then the other problem that you're finding is that if you want to do that, you've got to swap out of your currency and buy US dollars to go and buy US bonds. Let's say you want to own a 10-year. Well, that creates an FX swap, and the cost of that FX swap has been blowing out. So I was just talking, probably about 6 months ago, I was talking to a friend of mine who works in Japanese banking sector. And what's interesting there is because remember they got rates that are basically zero. They're certainly below the rate of inflation. And so Japanese investors are saying, well, can you go and buy me a 10-year bond? And they go, fine, we can do that. They got to swap yen for dollars and then take the dollars and buy the bond because there's a big rate differential. But they're actually not doing it. And the reason they're not doing it is because that FX swap has become so expensive because there are insufficient dollars available as the Fed sucks dollars out of the system. And so where you previously had a very, very small, like if you were trading your yen US dollar cross, those spreads are very, very tight because of deeply liquid currencies, etc., and they started getting more expensive. So it kind of, you get this self-reinforcing system, which is when you come back to Australia and the banks there, they're looking at these wholesale funding costs and they're kind of catching up, but they're still behind the curve. There will come a point where because more markets are forward looking, right? They'll start thinking, okay, well, we're at 3.5 now on the 12-month LIBOR. What's it going to look like in 12 months' time? If you just extrapolate on a linear fashion right now, you're probably looking at about 3.75, 4. So then they start pricing that, and then they start pricing ahead. So then the whole thing shifts really dramatically, really quickly. And we're talking, if we just take the 40% of the book, that can be a dramatic move. The other thing to think about, which is my point about that global coordination, if Australia was to have this crisis where so much is tied to the real estate market, starts contracting, you start seeing banks coming under pressure, you have liquidity problems, you have some bankruptcies, you name it. Will the rest of the world come and help Australia out? I mean, I think the odds of that are slim and none, and Slim's out of town. So you think even if the RBA just slashed rates, that just puts pressure on the currency, right? Which means your domestic, your FDI, your foreign investment into Australia will necessarily fall because there's a higher risk if your currency is falling. So now your domestic pool of capital that you've been reliant upon for the other 60% starts getting constricted as a consequence of the currency depreciation. And in order to stop that, you actually need higher rates to attract the capital. So they get caught in, it's like a rock and a hard place. And the other thing to think about is, as the currency comes under pressure, there's a lag to it, but that is inherently inflation. It's inflationary because the cost of your energy, your oil that you put in your gas tank, or you don't put oil in your gas tank, but gas in your tank, all these things go up. That means your bread at the bakery costs more. It means your Kellogg's cereal, whatever it is that you're buying, goes up. So that it doesn't really matter if you take capital away if you don't take discretionary spending away. You can take it away with higher interest rates, or you can take it away with inflation. You get the same net result. So I don't really see how the RBA can actually fix this problem.
the chances are, so you know, we run different scenarios, and John Adams and I have been talking about some of these economic scenarios, and our view is that the Reserve Bank will print, and will print big to try and effectively, you know, keep the ball going along a bit longer, because that's basically the only lever they'll have left, and they'll sacrifice the dollar in doing so. But as you say, that then creates more inflationary pressures. So it's they are caught, definitely caught.
All it does is it creates a lag. I could imagine I could imagine a market looking at that environment and saying, okay, we've seen this before, and look, Aussie did it in '08. We came out of it. We can do it again. And I think that would, if anything, it would give us a temporary reprieve, and someone like me will give me an opportunity to get back in and short the hell out of it, because I don't think they've got the capability in the medium to long term to sustain that, not without second order consequences.
And by the way, in 2008, the main reason why we didn't have a crisis here was we actually got help from the Fed. So a couple of our banks needed funding, right? So it was only
all those dollar swap lines got open. I mean, it was just like free money for all, and we all knew why we were doing it. But that scenario today is not going to happen. So the next that crisis of '08, what they did essentially was they laid the seeds for the next major crisis. And it's interesting. So there's two things. Firstly, fundamentally, they laid the seeds because they created balance sheet risk on sovereigns as opposed to private enterprise. But secondly, they also created a mindset amongst market participants, which also is now setting us up for that next crisis, because market participants are sitting there going, they did it before, we can do it again, and not understanding that the political environment today is 180 degrees different, and it's not going to happen. There's no ways that the Trump administration is going to give a toss about Australia's market or economy. There's no ways that they're going to give a toss about Europe's economy, and vice versa. We're seeing all of these, that it's a very different political environment today. And to think that the central banks are quote unquote independent of their political overlords, I think is quite naive. If we go back and even if that was not the case, the central banks were never put in place to save the world economy. They were put in place to look after their own monetary policy. And so if you just narrowly defined it to that, it makes zero sense that the Fed, for example, would help out the Australian economy, because the risk to the US economy does not come from something bad happening in Australia.
No, I agree. What's interesting, of course, because a lot of the investors here in Australia, and particularly international investors, are continuing to assume that our major banks are too big to fail. They will be supported by the government. We have the committed liquidity facility, which of course supports them, and so therefore it's if you like, it's a quasi overlay on the government debt in Australia, right? That's basically how it's looked at the moment. Yet I think that the risks that you're talking about are much more significant than many people see, and this is why we are probably less positive about the current banking structure that we have here. And as you say, the different international context that we have now suggests it will be quite difficult in a crisis to be able to deal. You couldn't deal with it in the same way as last time, which means that you've then got to fall back on some short-term strategies like printing, which probably won't be successful. And you're doing this at the time when real estate is already down 10 to 15%, right? That is 65% of the bank's books in Australia. And they are already with a proportion of loans underwater and more underwater going forward. Plus, of course, consumers are effectively seeing no real income growth. Cost of living are rising. The mortgages are big. They're under significant pressure. So we're already seeing defaults rising. So you can begin to see a scenario that suggests that the banks here, from an international perspective, international investor perspective, become less attractive?
Yeah, that you made a really interesting, good comment, which is around what the market participants are believing in Australia, which is that they have the facilities, they have the tools to deal with some of these, I'd say, eventualities. And yes, they do, but not without consequence.
Mm-hmm.
Is the answer. And so what you're looking at really is just an ability to hold off the wolf from the door for a little bit longer, right? But as I've discussed, if they do that in the current market environment, where you have a divergence in rates, when you have an ability for foreign capital to seek other sources, then you just get a pressure on the currency, and that creates that self-fulfilling prophecy. So yes, they could nominally maybe hold up to some extent, but again, not without consequence. And so, I guess if you're playing it, it's like, I mean, I look at it as both the currency as well as the banks, as well as you could look at discretionary spending, which is already coming under pressure. I mean, you can see that across the board.
Yep.
It's just a bit frustrating to me because I was a little bit late to, look at something like JB Hi-Fi, and I think it's the most shorted stock now in the Australian exchange, and it's still crazy to me. I want to be shorted, but I typically don't like shorting because I'm not that good at it, and I prefer not to short something. I prefer to buy things that are dirt cheap. But the point is that within the discretionary spending, you can see a lot of these. They're indicators. They're telling you how people are spending their capital or not, and so those are all there. What I think is probably most important within this whole space is that people forget, because they think about someone who bought a property. You're in Sydney, right? So let's say you bought a property in, I don't know, Mossman or something 5 years ago. So your 10% decline that you've seen in the last 12 months, you really don't care. It should be going up like 30% a year. Okay, so unless you've continued to leverage your equity growth, and some have, but unless you've done that, you're not feeling any real pain now. So it's not necessarily, the first thing isn't just your collateral, fall in your collateral values. That's a problem for the banks, but where it really comes is with the ability to finance, right? So, and we know that consumers are even the guy who bought his Mossman property 5 years ago, he's still just managing to pay his P&I loan on the thing, okay? Yep. So what happens if rates normalize? I mean, we can go back to say, I think it was 2011. Rates are like 300 basis points higher. And if you model, and you've done fantastic work on this, you model all of that, and it's like you can't fit a square peg in a round hole. It's like, how does this work? And so forget about the collateral values. When you have an inability to just pay your bills, that's most important, and that brings me all the way back to LIBOR and this wholesale funding. Again, because I do think, and I think you probably agree with this, the RBA will probably do everything that they can. They're not going to raise rates. They don't want to upset the apple cart. And they're going to do what many other central banks have done and failed in the past. I mean, you've got your most egregious examples like Zimbabwe and places like that, where they try and print their way out of hell. And certainly I'm not suggesting that we're looking at anything of that nature, but the point is that they don't have control of that market. There's other factors at play. And when I look at that global interest rate market, everything is moving now across every yield and maturity. Sorry, not every yield, every maturity. And that's only been in the last sort of 6 months, Martin. So, we believe the bond market topped out in roughly July 2016, which was when the Swiss 50-year went negative, and some poor dolt went and bought that sucker. Um, and they've been rising ever since. But at first it was on the short end of the curve, and then the long end it was like, yeah, this is basically what the Treasury departments and the banks have been thinking. Hey, this is short term. We'll take the hit. It's cool. We're going to come back. It's going to be lower for longer. It's all fine. Let's keep our market share. And now that's changing. It's changing, and you can see it in those bond markets, and you can see it in like the US bond markets. You can definitely see it in LIBOR. 3 months, 6 months, 12 months. It doesn't matter what maturity. Everything is just screaming higher. And so when you have that change in market perception, then you start repricing for the future. And so I find it hard to imagine a scenario where the Aussie banks they might have to curtail some of their wholesale funding. I would, if I was them. In fact, I'd get out as much as I could, and I'd, you'd start deleveraging, and fine, lose market share, but just stay alive would be my viewpoint. But that's all just interest cost, and they're going to have to pass it on in some shape or form. And that's then when you come back to that consumer, even the guy who's bought his Mossman property 5 years ago, and he's sitting on $2 million of equity or whatever the hell it is. That's not the point. The point is, if you can't pay your bill, you can't pay your bill. And so that's I think the most important for me, the most important kind of component in this whole puzzle, if you will.
Well, it's very interesting, Chris, because we model the household balance sheets, and we model cash flows, and cash flow is a real problem for many people at the moment, not just at the bottom of the market, but even more affluent households too. And the wealth effect as property prices went up and interest rates went down was quite positive, but we're now seeing the complete reverse. So effectively, many households are feeling less positive. They're having more difficulty servicing those loans even with current interest rates, and they're now more concerned about future interest rate rises. I agree with you. I think rates to the consumer, will have to rise, irrespective of what the RBA does. Which is one of the reasons why I'm relatively negative on the outlook here in terms of the overall economic performance. And the point is, this isn't going to necessarily take many years to shake out. I suspect that we're going to see a lot of this flowing through in the next few months, simply because of that pressure that's already been built up, as you highlighted. So I think the next 12 months, I've already said 2019 is going to be the critical year. I think we'll see a lot of this coming home to roost over that period.
I got a question for you, and hopefully you can help me on this. So we've been looking at the supermarket, so superannuation. Australian capital, I was joking to an Aussie friend just the other day, and I was saying, basically, you guys have got capital controls. And he's like laughing. He's going, what do you mean? I said, well, even institutional Australian money tends to be quite narrowly focused into Australia. And so if you're managing, even if it's self-managed or if it's institutionally managed super, what do you buy? Commodities have been in a bear market for 6-7 years. Nobody wants to touch them, right? So no one wants to go out and buy BHP. The banks. So there's a huge amount of capital has gone into the banks. Why? Because they're considered stable, they're rated fairly highly, and most importantly, they pay a massive dividend. Yes. I mean, the dividends of Aussie banks are huge, which also brings in, for me, a component, because if I'm short them, I've got to pay the divvy, and that's like swimming uphill. That's very hard. So we've structured trades around that to make sure that we can live through that. But the point is, all of that capital has gone. It's like, firstly, you've had Joey Freddie, who's gone out and bought his property, okay, and then he's got his superannuation. He's like, oh, what do I buy? And he's either invested in property in his super fund, okay, and there's been a lot of that taking place as well, and or he's gone and invested into the banks because he's like, oh, well, I'm diversified. It's like, no, you're not diversified. If they got 65% of their loan book in residential real estate and you're buying, like, by buying the bank, you're just buying a 65% freaking mortgage portfolio. So, my question for you is, what makes the banks cut dividends? Because when that spigot of capital comes off, then you've got all this mandated capital sitting in if you're an institution and your mandate is to buy corporate debt, high yield bond, like whatever. Basically, there's going to be, I don't know what the percentage is, there'll be a portion of that capital which will no longer buy the banks when the dividends get cut. And that just then cuts off another domestic capital stream for them in order to finance more mortgages. So we kind of looked at the offshore wholesale funding. Now we're looking at domestic and saying, okay, well, where are they sourcing that from? Yeah, sure, some of it's influenced by the RBA, some of it's FDI, which we've already discussed, which I can't see anything but coming under pressure if the RBA keep rates low or even cut rates. And now you've got this domestic superannuation capital, which has been flowing into the banks as a consequence of the dividend payments, amongst other things. So have you sort of thought about that, or do you have any thoughts on that sort of component?
Well, it's interesting because, of course, the superannuation pot in Australia is what, 2.5, 2.6, 2.7 trillion, depending on exactly how you, where you measure it and how you measure it, right? And as you say, a lot of that is actually invested locally rather than internationally. Some is done internationally, but a lot is locally. And a lot is going to the banks. And of course, the banks have done a sort of a double, triple pike with spin, you know, from the highest platform to try and keep the dividend payments up, right? So if you look at the last set of results, what they've done is they've reduced provisions to try and keep the returns up. But that is probably not very sustainable. And so then you've got the question of, well, where does that superannuation money go if it doesn't go into the banks? So the the financial sector is the biggest sector in the ASX, I think, and it pays nearly half of all dividends in Australia at the moment. So you can see that creates a whole additional feedback loop, and people haven't got to understand yet that it's the superannuation sector that is also going to take a bath in this environment, because effectively suddenly the returns are lower, or you've got to try and find other asset classes in which to invest that superannuation. And of course this is at the time when the Royal Commission has been highlighting very bad practice across the superannuation sector with fees for no service and those sorts of things. And so some of those other firms are also being hit over the head in terms of having to claw back significant profits to be able to actually remediate customers as well. So this is a whole second order impact. And I have to say, I have got this question in my mind as to whether the whole superannuation structure that we've got in Australia is actually now sustainable because of this. So I don't have an answer for you as to where that money is going, but I recognise the problem, and I don't think it's widely recognised yet in the Australian context.
No, I agree. And, look, then it's playing devil's advocate. What could bail Australia out? Look, Australia's basically always been, they manage their debt because they've got stuff in the ground. And so long as that they've managed to manage that, they kept going. So that is the one thing that I look at and I say, well, somehow, if because you always want to find out where you're wrong. Okay, we have this thesis and we have our positions on and so on and so forth, but then you want to always second guess it and go, where am I wrong? Because you're always wrong somewhere. There's some little component that you haven't quite figured out. And so, could we have massive amounts of that capital go back into the commodity market?
Depends if there's international demand, right? So that then takes you to the, well, what's happening globally? So if China goes off the boil and effectively doesn't take so much of the resources that we're taking, maybe India will take more of it. So there are potentially other markets So I think there is a question there about where those international markets may be, and that goes back to, so is this a local problem or a global problem, and how that works through. That's the first point. Yeah. Second point, which I think actually Harry Dent, he was here a couple of weeks ago, he made the point that Australia has one fortunate factor, which is a demographic factor. We've actually got very high migration, but there tend to be younger people. So effectively, the demographics here are more favourable than in many other economies. Take Japan, for example. And that does give us a little bit of a cushion in terms of actually going forward. So his view is that it's not the, we don't have a demographic problem. We actually just have a housing problem and a finance problem. So that may give us a little bit of a clue as to what could be a countervailing force when it comes to dealing with some of these issues. But I think it's going to be really tricky. I've said I think the next 2 or 3 years in Australia is going to be quite a tricky time.
Yeah, just on that point of the demographics, because I was speaking with a fellow hedgie over in Hong Kong who's an Aussie, and he was saying within that whole, so go back to sort of '08, and there was a massive opening of immigration. There was a massive influx, and that helped to, stem a lot of the issues in the Aussie housing market, Aussie equity market, and everything else. But he was saying that a lot of that that pool of people were actually not high-skilled labour force, a low-skilled labour force. And so when you look at the actual the trends within Australia, you're not finding high-level jobs, growth in high-level jobs. It's all been kind of mid and lower tier stuff. So back to your comment with respect to Harry Dent, I think there isn't. It's like, yes, you can understand that there's this labour force and you don't have those demographic issues. But as we're seeing with Europe, and certainly not to the same extent, but as you're seeing there, you've got now an increasingly large pool of younger people, but they're low-skilled, they're uneducated, and in many instances, they've come in as a consequence of what is essentially a socialist environment where they're like, hey, cool, free healthcare, free education. It's like, if you and I were sitting in Morocco and we saw that as an option, it's like it's a no-brainer. It's like all you want to do is get on a boat immediately. And so that's not necessarily conducive to wage growth or to economic growth.
No.
I don't know exactly what that demographic makeup looks like in Australia, but he was suggesting that it's a lot less sort of good than many economists are making it out to be. They're saying, maybe like Terry, so it's a good thing, and we've got all of this low, young population and so on and so forth, but. Young population doesn't always solve those problems. I mean, you look at Africa. Africa's full of a young population. Places are so. Yeah,
it's a good point. I mean, it's worth sort of, as we sort of come to the end of our conversation, it's worth highlighting. I think that the biggest growth sector in terms of jobs at the moment is low-paid healthcare and ancillary care services, right? Because effectively what's happening is that we've got a bigger and bigger older population who are needing more support to be able to, as they age and as they need more healthcare support. But those jobs are not well-paid jobs. And that's one of the reasons why we see employment rates relatively low, but in fact wages growth going absolutely nowhere. So again, another factor in terms of the mix is the job mix and all of that sort of stuff. So I sort of agree with you that just because we've got younger people, it doesn't necessarily translate to being in a more fortunate position. It does depend on who they are and what they do and so. So if you stand back and say, okay, so the factors that Australia is having to deal with is rising funding costs internationally, the bank's under pressure here from all sorts of reasons that we've discussed. The demographics may be working in our favour to an extent, but not dramatically. And then, so what is that get out of jail card? And I'm not sure that I see one. So I don't think we've had a plan B. I think we've assumed that the housing sector and the finance sector will go on forever. We've assumed that the resource sector will go on forever, and that's what's created the lucky country. But frankly, it's a bit myopic, and that's why I'm a bit concerned about what's going to happen ahead, because I don't think we've got any political drive to think more broadly about what is that next wave, if you like, that's going to create the next degree of prosperity in the country.
Totally. And you're seeing political dysfunction. I mean, tell me the last time Australia had as many governments.
Yeah, that's just embarrassing.
And so, yeah, but it's a symptom. It's actually just a symptom of a wider problem. People look at that in isolation and they go, oh, this, that, or the other thing. So forget about it. It's a symptom. And so much like I speak to friends and colleagues and that in Europe, and they tend to be just looking at their own, whether in Switzerland or Germany or whatever. And I'm like, if you look at it on a global basis, what you've got is just a symptom of a much, much bigger issue. And I want to make one point with respect to those low-cost jobs that you were mentioning, which are basically looking after old people. So you've got your demographic issue. All the boomers are retiring and dying, and they need looking after. But that structure, post-World War II structure that was built up was a socialist structure. There's a lot of working. The contract with the government was this: I'll pay you taxes and you'll look after me when I hit 65. That was basically it. Okay. The problem was that the government spent all the money, so there is no money sitting in those coffers to look after them when they're 65. So they need to now bring in more capital. So they're trying to, in Europe, they're trying to bring it in with refugees. Australia did a similar thing. They brought in all these people. What's happening now is that those people, in many instances, are actually requiring so many of these benefits. Okay. But B, where they're working to look after the old folk who are retiring and in old age homes. But that capital is just a capital flow from the governments. It's part of their debt structure. Okay, so fine, you brought in people, but you're paying them with more debt. Essentially, that's the way the capital flows. That's not sustainable. That just exacerbates the problem. So, yeah, it's interesting when you see these comments from economists and they're like, oh no, this is fine and this is what we're doing, and you're like, well, if you just work through how the capital flows, you can hang on a second, you guys are just making it worse.
Yeah. No, I agree. Well, I talk about the debt crisis, the debt bomb, the amount of debt in the system, and it's not necessarily just public debt, but it's private debt. But the combination of those things suggests that we actually are in a relatively unsustainable position. So unless there are changes of policy, and changes in some of those will have to be quite significant, I suspect that we're going to muddle through, but it'll be relatively uncomfortable over the next little while, which is why I suspect that some of the international investors may decide that Australia is not the place to fish at the moment.
Yeah, and that's part of that's that domestic capital that has been always there, and the longer something's there, the more you think it'll always be there, until it's not.
Really good point, Chris. Chris, thank you very much for your time today. It's been really interesting talking with you and discussing some of these macro issues. Very interesting, and I really appreciate your perspective.
I fully appreciate your time, and thanks so much for all the work that you've done in this space, because as I mentioned at the start, I'm not a specialist in the Aussie housing market, and so I've learned quite a bit from the work you put together, and I thank you for that. And it was fun chatting.
Great, thank you very much.